We spoke about my investing, and I said I was a global index investor, and he said we need to talk about that. So I think I want to talk about that because I'd like you to pull me apart. And
no, I'm not going to pull you apart. I mean, you're absolutely right. It's a great way to invest, and it's been a great way to invest for a couple of decades, and it's cheap. And that's the key thing, because we always say that when you look at your investments, you don't know anything except for the price.
Yeah, you can only control the fees.
It's the only thing you control. Everything else is totally unknowable. And the fund management industry has this extraordinary thing going on where it's literally only them and the government who can take money out of your pot at will. You know, you pay a lot of stuff in direct debit, but that's from your own bank account, etc. That's your pot that you control. Only the government can reach into money and take their share out before they give it to you. And the fund management industry is the same. So what I mean by that is the government can just reach into your pay packet and take out whatever taxes it designates on any given day. And a fund manager, the fee changes depending on the value of the assets under management and that kind of thing. But their pot rests with them, and they can just take out the money again, as and when. And these are the only two organizations that I can think of that get to reach into your pot to take out differing amounts of money, regardless of your permission on any given day. And so they have a huge responsibility there. Anyway, back to fees. Yes, that's the key thing, that it's cheap. However, index investing is also momentum investing.
Yeah.
Right. So what you're doing is something goes up in price, you own more of it. Goes up in price more, you own more of it.
Yes.
It's market cap related.
Yeah.
So you do well when market's going up. That works very well. But in this environment where everything is a little more choppy, I'd be more minded to have an equal weight index. So where every company inside it, you hold it at an equal weight, which means it's constantly being rebalanced.
So just to explain to you, Apple is a large proportion of the global market, maybe 5%. Yeah. Apple's actually bigger than the whole of the UK weighting in my portfolio because the UK is 4%. So 5p in every pound gets invested into Apple. Yeah. If Apple goes up to 6p, like 6% of the global economy, more of my money goes in. So I'm pouring more money into what might be an expensive business.
So they should all be the same weighting.
So and we used to do an investment trust portfolio for our readers, and it had trust like had Scottish Mortgage in it, which is a huge growth trust, right? And then it had things like Personal Assets Trust, which is very based on trying to protect your capital, and RIT, which again is not quite the same thing. And we told our readers every 6 months, as Scottish Mortgage soared and soared and soared and soared and soared during the last decade, we kept saying to them, you have to rebalance every 6 months. You've got to keep this equal weight. So sell some of your Scottish Mortgage and buy some of the Personal Assets or Caledonia, or whatever the others were at the time. And when Scottish Mortgages, as interest rates started to rise and inflation started to come and the great growth bubble started to collapse, and shares in Scottish Mortgage plummeted, I looked at it and I thought, if they'd done what I told them to do, they'd be in absolutely great shape because they've captured an awful lot of the bubble, but over time they'd have transferred the bubble money into more capital protection funds, and it would have been great. But of course, none of them did, because it was almost impossible to give up the excitement of the constant rises in the share price of Scottish Mortgage shares. It was really tough to do, to say, oh God, look at that, it's going up, 20% a month, and she's making me sell it.
So do you think this is just an approach for times of volatility and uncertainty, or at all times you should balance your portfolio, rebalance?
I think you should rebalance a lot. I mean, there's an argument here in the market about whether you should run your winners or whether you should rebalance. And the thing about running your winners is you never know when they're not going to be winners anymore, So I'm a keen rebalancer.
How are you rebalancing if you've got, say, a global index fund though, which is just a one fund that buys the whole market?
Yeah.
You're screwed. You're screwed.
Tough, isn't it?
You're done, Damo. We had an awesome chat with Marion Somerset Webb. Check it out right here.